Hey traders, today I want to look at an example of a poor man's covered call, which is a favorite strategy of mine for a stock that I'm bullish on. Obviously, none of this financial advice and all that sort of thing. Do your own due diligence. This is just for example purposes. But let's say we were bullish on VEEV stock. The example I've got here is we're going out to January 2022. So we're going out on a long-term option. This is a leap option, and we're buying that option. I like to be around Delta 70. Okay, so getting roughly 70% of the price move with that option. It's going to cost about 7,100 to buy that call option. And then looking at selling a 310 call option for November. So that's a month and a bit until expiry. We've got a little bit of capital gain potential because the stock's at about 295. So we've got a little bit of upside potential, selling that for around $10.45. So about $1,045 for selling that option, brings the net price down to about 61,000. So that's the most that we could lose on the trade. That's the capital at risk. By selling that premium, we can see that the break-even price is slightly below the current price of the stock, thanks to that premium, because obviously the short-term option here that we're selling is going to decay a lot faster than this longer-term option. You can see theta here is 20 on the short-term option and just -5 on the long-term option that we've bought. We've got positive delta. It's a bullish trade. Delta of 32, if we multiply that by the stock price, we get a delta dollars of about $9,000. So you need to relate that back to your account size as well and just make sure that's not too big for your account. If you're trading a $10,000 account, then this is obviously too big. But if you've got a $100,000, $200,000 account, then this is totally fine. All right, so you can see here we've got some upside potential up until about 310, which is about 5% higher from here. And profits start to drop off a little bit after that, but still in profit on the upside, no matter how high the stock goes. And earnings on this one are on November 26th, so we've got no earnings risk here with this option. And the idea would be to close out the entire thing before earnings. And hopefully we're sitting up here anywhere from the current price of 295 up to about 315, even sort of 320. A lot of times we'll see these strong tech names will rally into earnings on the expectation that they're going to have a positive announcement. But as I said, I wouldn't take this exposure over earnings. I'd want to close it out right before earnings. So in terms of risk management, we're risking about, say, $6,000. A 10% return would be pretty nice. Anywhere from sort of 10 to 15 would be pretty good. And I'd probably have about a 10 to 15% stop loss as well on the downside. I'd also check the chart of the stock and look at the 50-day moving average, which comes in at around 270. So that's another potential place to have a stop loss. If we just change this to price, you can see 270s down here be down potentially about 750 or so. So that's, again, that sort of 10 to 15% range. So if the trade's not working, want to be out of it pretty quickly before it goes any further below that. This is our T+0 line, the purple line. The blue line is obviously our expiration payoff line. And this is just going to slowly drift up towards that blue line as we get towards expiry. So if we move this out a couple of weeks, let's say 3 weeks or 2.5 weeks, you can see that purple line now comes a little bit closer to that blue line. So ideally 2 or 3 weeks from now, we want to be sitting up here around 305, 310, even potentially higher. We're going to be doing really nicely up here at about 320. So there you go. That's a poor man's covered call, how to set one up, and also some info there on profit targets and stop losses. If you're a bit more bullish on the stock, you would place the short option a bit further out. So I've gone with 310, which is giving about 5% upside potential. If you were much more bullish than that, you could look at doing the 330, which is going to bring in less premium. So you've got less downside protection as well, but you've got much higher gain potential on the upside. So you might structure it that way if you're a lot more bullish on the stock. But I think that's a pretty good area to be personally. That's a 37 delta. I'm okay with that, and I think that's a pretty reasonable setup. That's something that I look to do pretty regularly on stocks that I'm bullish on. So there you go. It's a poor man's covered call. If you've got any questions, let me know. Otherwise, have a great day.